Alessandro Hatami. You can see details of my background on LinkedIn if you're interested at any point. But I've been doing fintech since 1999. I built G Capital's first website in Europe. I was employee 11 in PayPal Europe. I was the CEO of Paypoint.net, and I was the chief operating officer of the Lloyds Banking Group, of the digital bank of Lloyds Banking Group, responsible for innovation and everything that happened there. I'm also a board member of Cash Plus, the latest digital bank in the UK, and I'm an investor and mentor. I have a presentation that I put together that I'll share with you. What it is, it's a perspective of how banks are evolving and how they partner with. Since I left Lloyds, I've created a firm called Pacemakers, and we focus on partnering and helping banks partner. And what you'll see in this presentation is some of the challenges and situations that I've seen, but taking a very big step backwards and saying why partnering is the way forward and what to look for and what to avoid in engaging with partnerships. And also trying to give you a foundation saying, okay, why is this happening and what are the opportunities there? So I just beg you to bear with me because I'm going to take very, very far away, very distant lines from banking to explain what's going on. Okay, this is me. I've mentioned some of the stuff that I do, and I think one thing I'm quite proud of is the book Reinventing Banking that's been rated the best book of banking of 2021 by Investopedia. A lot of my ideas are captured in that, so I think you'll enjoy that. But I think the more important thing in this list is the fact that I'm a mentor of startups, and I find one of the things I would advise every single one of you is to become a mentor, because that would really shake the way you think about fintech and the way you think about innovation and how companies, how banks, how fintechs operate and how they can do to transform. So let me take you forward. I think what you want to see is what is happening right now, and I'll just give you a very quick, even though you already know, thought it'd be useful. This is the former CEO of Citigroup with his perspective on fintech, which I think we all share. This is what's happening, and this is why it's happening. Even post-pandemic, investment in fintech is still quite impressive. If you think about 2013, that we were talking under 7 billion, getting to the numbers we are today is very impressive. Also, COVID has made a big difference in the way people engage and people think about digital banking. And these are some of the statistics. Marisol, you asked me if you wanted to have some more updated figures on this, and this is what I got my hands on. This is McKinsey. And I'm sure in the Nordics is even more profound, even though you were already quite digitized. So this is the big step backwards that I'm going to take, is why is this happening? And this was triggered to me from this comment from Peter Sands, from a CEO of Standard Chartered. It said, we are heading towards a Spotify moment. What does that actually mean? So there's a lot of young people in the room, but this used to be the way we bought records many, many years ago. So this is how we listen to music. You have to go there. There was some guy listening to tell you how stupid your choice of music was, and then they would help you, maybe take you to a place where you can find the better choice of music. That quickly evolved into this. I'm sure some of you remember this one too. This is iTunes. iTunes was exactly like a store. You were still buying the digital product, still buying music, but it was a digital version of your music. So it was an evolution, if you want, of the business model. And this was supplanted by this. And I'm sure all of you are on this right now. And this is music streaming. So the music that you want right now is that you no longer buy music. We no longer buy albums, records, CDs, or anything. We are buying access to music. So if today I feel like Easy 70s, I just go listen to that. And every song that I want is available, or almost every song is available. So that's a paradigm shift. And that's a complete transformation of a business. So if you think about Tower Records, what they did when the digital revolution hit is they created Tower Records online, and they tried to sell their products online. This was replaced very quickly by iTunes, that decided people don't want to buy the physical record, they want a digital record, and they sold the digital record. And obviously was transformed with the arrival of Spotify. What happened in each one of these situations is Tower Records, as we know, is no longer with us. And when they opened in 1961, they quickly became the biggest provider of music. And when Napster launched in 1999, Napster was the first music download. It was an illegal business, but it was music downloads. they reacted with it in very little interest. They were thinking, these are never going to be big enough for me. So they were not worried about the transformation that they did until it was too late. And they went bust in 2004. So it took them 5 years from their challenger to come and destroy them completely. iTunes then took over and did not respond to the Spotify launch in 2006 until they decided to start streaming in 2015, and they stopped downloading it altogether in 2019. So these business models were completely supplanted by what we call the dilemma zone. And the fact that in that area where we are right now in financial services, not knowing what is the right direction going forward, what we are doing is that we are waiting for the next model to come in. And as businesses, we are not prepared and equipped to be able to deal with this. So let me transpose this back to something closer to us. If we look at this from the perspective of the banks, I think a lot of the banks, a lot of traditional banks are actually like Tower Records. And they are selling their products in digital version, but they are selling their old products. A lot of the challenger banks that have come up are selling a digital version of that. So they're doing it more efficiently, but they're still selling a digital product. And we still don't know who the Spotify is. So what I'd like to do today is actually try to explore what this Spotify could look like, and then go back to see how you could actually become that, or if you actually even should be thinking about becoming that. So if you look about the 3 stages that banks go through Innovate, I call them the adapt, evolve, and transform stage. The first stage is where most banks are today, which is focusing on digital to drive top line growth and to do cost takeouts. It's seen very much, this is how I do business. Digital will help me transform, will help me reduce my costs, will help me sell more. In doing this, they generate new products and new proposition and new capabilities. And these become fundamental in actually thinking about where the direction should go. But we are still very much adjacent to what we're doing before. So imagine top line growth would be being able to sell current accounts online. New products will be a PFM tool, or the ability to track customer spending, alerts, all different types of chats, things of that kind would be part of that. Telling customers what the carbon footprint is, for example. Things of that are an evolution of what they are, but they're still very much related to the current account, but they are using a technology that would not be possible to use in branch, and delivering a service that would not be possible in branch. What this does is that creates 2 things. It creates culture change internally. So people and individuals start thinking differently about their organization, and new talent is attracted, which then leads obviously to new business models and eventually to the new bank. So this is the stages we are seeing. In my experience, in all the clients that I work with, and I work in clients that range from companies in Asia all the way to Europe and to the UK. I have one US customer, but that's not very representative. Every single one of them right now are either in the adapt or in the evolve stage, and nobody from I can see in the Western world is in evolve. And I'll tell you that maybe we are seeing the appearance of the new business model and the transform base in China. Some of the models that we are seeing emerging are, and this is a proposal, a framework that I presented some time ago, which is now used at the State Business School, that talks about the different modes of banking that we are seeing in the digital world. And this is the most traditional one of the banks. So we create a digital banking interface at the front, while in the back end, we retain what we have. And this doesn't mean that this is the legacy banking platform is not the COBOL-based Fortran written documentation that we had from 20 years ago. This is an evolution of that, but it's still a very traditional core banking platform. By the way, if you have any questions, observations, disagreements, and you want to say that you think I'm saying stupid things, please do raise your hand. It really helps me improve my presentation, review my thinking especially. The next stage is the new bank. This is a built for the new world bank, and these are the starlings of this world, the number 26s and so on. The third level, which is more interesting, is, this is number 26. So this is the distributed bank. So the bank becomes the front end engagement with the customer. In the back end, you either have a banking platform, but potentially you have other fintech providers. So the banking as a service discussion that we've been hearing is very much along these lines. The fourth one is the disintermediated bank. So the point of reference is that the social network becomes the banking interface. And in the back end, you have a bank and you have fintech providers. And this is a model that we see emerging quite a lot. But if we brought everything together, we can actually see a fifth model, which is something that was suggested to me by the CEO of Zest in India, is this model. and what they call the bank that actually becomes a channel. So it's all three components of banking today work together to deliver banking through a social network. So it's no longer, what we need to be thinking about is this. So we look at the banks and the fintechs creating a layer of manufacturing the financial product. The fintechs become the distribution of financial products because of their ability to engage with better UX and better interface. And the actual and last mile delivery will be done by the social network in an embedded fashion. So financial services will be embedded within the organization. What helps you also to think about this is a kind of a layering and thinking about the different layers of how this can be provided. And I think that this is a model that we may not be all of us, may not be all the banks in the world would be doing this, but I think this is a model that will be something that we will be competing against. And it's something to think about. Any comments on this? Do you have any observations? Usually I say people crying when I present this. No response.
I would just point out, Alessandro, what we discussed when we were talking. And I remember when I was at BBVA, one of the things that Francisco Gonzalez, our former chairman, always said is that banks should fear to become just an infrastructure, no? And these first layers that you have in manufacturing is what many banks might become, no? Just a factory of product or service of financial services, no? And it seems that it makes sense for me, at least. It's impressive, and certainly
it is. But the interesting channel is it may be profitable. Okay, it could be something that you may want to do, because if you don't have to have any branches and you don't have to have any front end, and you concentrate on producing the best possible product on the back end, it may be worth your while. Okay, so I thought that this would be a good place to take it. And then I wanted to go a bit further about showing you what examples are happening of this already. This is a Chinese model. So this is a company called Sunline. They have engaged all the mid-sized banks in China are part of the Sunline thing. Many of the banks that you see in the manufacturing parts have no digital presence, okay? And Sunline aggregates and digitizes them using very simple APIs on the back end. Oftentimes using what is connecting to their ATMs network. Okay, so existing. And what happens, Sunline then provides this service to WeChat. Okay, so if you do banking through WeChat, we can get all of the banks in the country transparently offered by Sunline and seen invisibly or practically or embedded within the day-to-day life of the customer. So you can buy your pension, you can buy your insurance, you can buy a loan with all of these banks provided by WeChat in an invisible way. And the challenge with that is that for investment products, yes, you know who they are, who you're buying from, but for loans and more generic products, you don't know. So you think, is WeChat giving you money, which is maybe good, maybe bad. It's just something to think about. Okay. So I thought it would also be useful to say, where are the areas that we should be thinking about within a bank of where transformation can occur? And these are, I like to simplify life in talking about 3 different layers within a bank that are key for collaboration and partnering. And I call them the interaction layer, the processing layer, and the analysis layer. The interaction layer is where you engage with the outside. The processing layer is where you do the banking, for lack of a better word. And the analysis layer is where you start thinking about what is going on, and to be able to create connection, to create knowledge and know-how and understanding of what is happening in the previous 2 layers. These are then connected to each other with a variety of different platforms. And I think the connective layer is the more interesting one, because what is happening right now is it becomes quite blurred. What is the line of analysis and what is the line of processing, and how this provides the interaction? So I think this is a schematic that I often find my clients use in actually trying to understand where they want to make an impact in organizations. Okay, so far? Am I boring anybody, or still have everybody? I'm not seeing any sleepy heads, but that's a good sign, I would assume. Okay, so let's take a step towards the customer now and just focus on them. What is it that they really want? So if I think about Spotify, as we said, customers don't want to buy records, they want to buy music. What does the Spotify of banking look like? It's customers don't want to buy banking products, they want to buy outcomes. They want to buy what the product allows them to do. So if we created a bank that did this, how would it look like? Okay. And I think this is, today, if you look at what the basic needs of the customers are, is there are three needs. They need to pay somebody. That's need number one. Two, I don't have enough. I want to borrow some and I need to get some credit. Or three, I have a bit of extra, I want to protect it. Okay. These four interact with what they expect from the bank to be providing them is what is the best choice for me. Okay. So right now, what we do to the bank, to the customer, when they come in, is that we say, you can pay, you have all these choices of payment, but you need to decide which one is best for you. You have all these choices of credit and I can decide, and they're priced completely differently. And based on what I decide, you have to pay more or less for credit, even though it's the same thing. And you have a bit of extra and you can do whatever you want with it. You can do savings, you can investment, you can do pension, insurance. I'm not going to provide you with advice. I'm going to give you some generic information of what they are. And this is definitely, as we said, not what customers want. So if we were looking at the bank of the future, the Spotify of banking, it would look something like this. There will be a universal payments account, which they would tell you. You tell them, I want to pay my holiday in America, or I want to pay better. They will tell you what the right thing is, and they will give you some choices in that would be relevant to you. You don't really care if your money goes through Amex, Visa, direct banking, PayPal, iTunes credit. You don't really care. You would like somebody to take care of that for you. And that's what the bank could do. On the master credit line is the other thing you want to I want the bank to lend me the money. And the bank lends me the money because they trust me and because they want some extra collateral. So I want to be able to go from overdraft all the way down to mortgage while the bank holds my hand in telling me that. So the bank is always there for me and creates a credit product that includes the range that I said, priced differently based on my circumstances and the value of the assets that I'm working on. But ultimately, a situation where actually I am borrowing from the bank in one only way, in one single payment line, not to worry about multiple products. And the last product is the capital protection plan, which is I have a bit of extra. I want to be able to put it into savings. I want to be able to put it into an investment. I want to be able to buy a pension with it, or I want to buy an insurance with it. Ultimately, all these products do one thing. They help me protect my capital and safeguard for the future. And this is it should be a whole of market, because as a bank, I cannot provide every single functionality available in the market. So I want to do the whole thing. But what I want at the center is what we talked earlier, and I think you mentioned about the chatbot, intelligent guidance. I want somebody that'd be able to guide me, not advise me, but guide me in making the right decision. So I thought it was interesting. So this is overall my perspective. I just want to give you one last perspective on who is actually doing all these things and what is happening there. And this is a famous quote from a good friend of ours that we all have had to deal with in the past, unhappily, probably. We don't need banks, we need banking. So what does this look like? So if you think about it, there's four major players in banking today. There's big tech, very big, multinational, huge client base, don't care about banking, and they're very well known globally. The global banks, these are the INGs and the BBVAs and the Citigroups of this world. They're big, multinational, huge client base, very complex, profound, the legacy issues, and they're well known globally. Then you have the regional banks, and these are smaller. They have a regional footprint. They have a smaller client base, but this client base likes them more than they like their corporate, the giants. The smaller banks have a relationship with the client which is different. They have fewer legacy issues also because they have invested in and they have less complexity and having not being the result of multiple acquisitions, but also because they have simpler products and they are known regionally. So they're a brand that people trust potentially more than the global brands. And then you have the fintechs, obviously. These are the guys that are trying to innovate the market and trying to transform the financial services world. So I thought, let's try to use three metrics to compare these three and see where they stand. So I chose three metrics to compare them with. And the metric number one is access to customers. So as we said, both big tech and global banks have access to huge customer bases. I think regional banks have access to less customers. Fintechs and challengers have even less access to customers because of the fact that they're just new. Then we have access to capital. I think big tech and global banks, as we said, have huge access to capital. They are very deep, very deep pockets, and they do quite well in spending in innovation. The regional banks have more of a challenge, so they don't have the deep pockets of the big banks. So when I was at Lloyd's, we created a digital banking app that cost us probably just short of 100 million to do. So 100 million is the budget of several years in some banks. So that was just for creating an online banking API, an online app to be able to serve our customers. Which is a huge amount of money. I assume that is also that's a very big challenge to be able to do if you're a smaller bank. The third element is access to innovation, and big tech, they are at the core of innovation and transformation. Global banks can pay for it. They have the money to pay for it. The fintechs and challengers are innovation. So that's what they're all about. But the regional banks are challenged in that. So if you look at it, it looks like on paper that fintech is the enemy of the mid-sized bank and the enemy of the regional bank. But there is a way forward, and this is exactly what I wanted to talk about today. Long story to get there, is that these are some of the outcomes of what we are talking about. So if we look at the way things is evolving, the fintech is evolving and digital transformation is evolving, I think we will see inevitably that big tech will offer banking. They will become more profitable and they will be more entrenched with our lives. So they will be even more embedded with what you do every day. And they will do this by partnering. They will do this by partnering with big banks and fintechs. They will become the channel for these guys. And especially for types of banks and types of fintechs, that's the best way forward and also the most cost-effective one. What the global banks will do, they will be disintermediated. And I'm not going to be surprised, and some of them will fail, but I don't know which ones, and I'm not going to point any fingers. But what will be sure is that margins will contract. So they will be making less money from the specific products. Does it mean they will be less profitable? No, because by partnering with a big tech firm, they could take away layers of cost. But ultimately, if you look at the profitability of specific products, that will have to go down because competition will become more aggressive and more transparent. What regional bank will do, some will thrive and will do this by becoming niche players. And by niche players, I'm talking about not only niche products, but niche segments, by focusing on specific segments that are underserved, underbanked, and undertaken care of. And these can be geography, these can be stage in the evolution of their lives. This can be something that will really make them distinctive, the areas that original global banks cannot differentiate enough to be able to reach. Some of them will fail inevitably. And many will partner with fintechs because they will realize that that is a really fast and efficient way to be able to evolve and to transform. What the fintech challenge will be is that many of them will get disintermediated. So all of these big fintechs that we're seeing right now, there was an interesting report made by JP Morgan some time ago. None of the big challenger banks are able to survive with under 10 million customers. To get 10 million customers, it's really expensive and really difficult to do. And so they would suggest that their model would be that to be acquired either by somebody like BBVA or to end up in becoming maybe irrelevant and fail. They will become specialists at what they're doing. So what was really great about some of the fintechs that we know, and they're very good at what they do. So TransferWise is really good. So Wise is really good at foreign exchange. They're very specialized. The same goes with Revolut. As they start expanding their product range, we will have to see if they're going to be competitive. And they will be partnering. And generalist banks will be hard to find. You will not find many of them around as much as we would expect. So going forward, I think you actually also want to focus again on the two other parties that are part of this whole discussion. The other two actors that we will see are customers and regulators. And I think customers will have more choice. So this is a good news story for the market. They will have more choice, they'll have lower costs and better user experience, but they will be linked deeper to big tech. I think big tech will become an integral part of their lives. Regulators will have to expand their areas to other areas. Financial regulators will have to expand into data. And I think we are seeing this already in several markets to do that. And more importantly, there will be cross-market coordination. And this is something that I recently wrote at the Italian Harvard Business Review. Europe has an advantage potentially across the rest of the world because they have a coordinated regulation. The European market has 300 plus million people that are regulated in a very similar way. This is very different from the States, who doesn't have a central regulation, or some of the other markets that are much smaller than that. So potentially regulation could be the best friend of innovation. So far, so good? Any questions? Okay. So I thought it would be just good to kind of focus and center just a second about why is big tech interested in this? And we all say that they want to do it. I just wanted to make it very explicit about what it is, because I think that will make a difference in the way you can think about partnering with them. So, and their successes. So these are the GAFAs of this world plus BATs, the Chinese companies. They all have, you're familiar with all of them, I'm sure. So what do they want? So these guys want data. So Facebook, Google, Tencent, and Baidu, they want your data. They want to complement data to sell better ads, to sell better click-through rates, and so on and so forth. Baidu and Tencent are exactly the same. They also want stickiness. So the only reason Google does the Google Apple Card is they want to make sure that your next phone is an Apple phone. Okay, and that is something that they're willing to invest. They did the same to music. So they never wanted to become a music distribution system, but they just want to make sure that your next phone is an Apple phone, so that you, so they sold you music, so that all your music was on your phone and you would not buy something else. And the last thing that they want is they want to sell more. So sell their own product, but sell financial products. So Amazon would like to get to a place where you have an Amazon account and you buy a mortgage, and the mortgage is not you linked to a mortgage company and then you are underwritten. They are able to underwrite you because they are the connective tissue directly to the bank. The same goes for Microsoft, and Alipay and Alibaba are doing that already with Ant Financial and everything that they're doing. Does that make sense so far? So I think I wanted to just to finish off with what is it that is driving them? So the goals, as we said, the big tech has is to more insight, sell more product, and to get more engagement. What they don't want, though, big tech doesn't want to be regulated. They don't want to be exposed to losses that they're not familiar with. And they don't want their existing profitability impacted by fines or any type of issues of that kind. So what that leaves them with is this. They will be doing that, and that is going to be the future. So be prepared in engaging with, partnering with them. And that's, I want to take you some takeaways if you want. All of this you already know. The digital transformation is still underway. Digitizing your existing processes is not enough. I think that is something that I'm sure you're all familiar with, and you've seen that before. The innovator's dilemma is what the banks are facing now. So they've all done the adapt and the evolve stage. So they have gone to the limit, and you're facing the wall that the carriage companies faced when the first car emerged. Either you're going to be containing and becoming the best carriage company, or you're going to decide and you move on and become a car. So that's something that is important. Partnering will be key, and that will be a core of everything that we want to do. And partnering at the 4 layers that I showed earlier, I think it's not going to be just I partner on the top end, because most of the partnerships we're seeing are engagement to the customer. I think there's a lot of partnering that can be done inside. And smaller banks should leverage their scale to partner, especially because you're more desirable partner for some of the fintechs, because the ability that the smaller bank has to be more versatile, more flexible, more accessible, and less bureaucratic than the big guys is something that would really help them. So thank you very much. This is my book, by the way, and thank you for your time.